Joining us now, Apollo Global Management's chief economist, Torsten Slok. This has been going on now for a while, Torsten, where China has been unloading treasuries. You expect the trend to continue?
Yeah, so the backdrop is exactly as you're saying, that Chinese exports have been slowing down. And why have exports been slowing down? Well, partly because the US has been slowing down and Europe has been slowing down. So if your exports slow down, that also means that China has fewer dollars to recycle into treasuries. So if China has less exports, that also means that they therefore get less dollars in their hands to recycle it back into global markets. And that does mean, therefore, as you just showed in the chart, to that point, that there is likely to continue to be less demand for US treasuries from China from that front.
So do you think it's something that the market appreciates? Do you think it's factored in? How does it move the Treasury market on a day-to-day basis? Because when there was a big sell-off a few months ago, you just added it to the list. China's unloading treasuries, and then there's not going to be as much demand. But now there's been a pretty furious rally here, and people aren't worried as much about it.
Yeah, no, this is very important. So there is a list. So if you just back up a little bit and ask what's driving rates, it's very clear that the economic data, expectations to the Fed, everything that's going on short rates is absolutely a key driver of long rates. But exactly as you just mentioned, Sarah, we have also had a number of other things that continue to be still lingering a bit in the background. Not only is China slowing down and therefore exports slowing and therefore less demand for treasuries from China, but we also have that Japan is exiting yield curve control. That means Japanese yields have been going up. And remember, Japanese investors hold more than $1 trillion in US treasuries. So if Japanese investors find their own yields in their own backyard more attractive, that's certainly also a risk for U.S. rates moving higher as Japanese investors begin to take more money home. And finally, the biggest risk really is still the supply of treasuries and the supply from the fiscal deficit front that continues to be a lingering issue in the background. So yes, you're right. So far, the rally we've seen in rates in the long end has been driven almost entirely by the idea that the Fed may be done, and I agree with that, and therefore maybe short rates should be going down. But these other issues, again, remember, it's not only more than a few weeks ago we had a third-year auction that didn't go out very well because we simply did not have enough demand. We will have plenty of 10-year and 30-year auctions going into next year where the market will be revisiting exactly the issue, what are these other things implying for rates. So the bottom line is, yes, so far so good, but the risk is still that long rates will be having some upside pressures coming from these other sources, namely China slowing, Japan exiting yield curve control, and the significant supply of treasuries in the pipeline.
Yeah, we have some auctions even next week, I think, on the longer end of the curve, Torsten. But I guess the question is, does the rally that we've seen so far not somewhat dilute the idea that this was mostly a supply shock? I mean, really, if you pull back, is there anything particularly strange about a 4 to 5% 10-year Treasury yield, given where nominal GDP growth is and given where, where inflation still is?
Well, that's a very important point, Mike. But you're right that maybe we did go up too much when 10-year rates hit 5%. The big question is, where are we going on short rates? If short rates are going down to, the Fed is predicting over the next several years, down to 2.5%, well, then maybe 10-year rates, if you think the term premium or the risk that you're paid for taking more duration should be roughly 0.5%, that means that 10-year rates should go down to 3.5%. So in that sense, we have unwound a lot of the increase in rates that we had. So you're right. So far, so good. It does look like it's mainly driven by Fed expectations and the economy, but let's see these other things. They definitely come and go. And in particular, this issue of auctions, as you're saying, even next week, we got to continue watching very carefully what's happening to the bid to cover ratio in long duration options, what's happening to foreign bidding, how much the primary dealers have to take down. All those things will just continue to intensify because we know one thing for sure, and that is that the supply issue for treasuries is not going to go away. It's just only going to continue to get bigger and bigger as we go through the coming months.